That's good?
Well, good.
All right.
Fallbacks.
So thanks again, everyone, for having us. I really want to thank DealFlow for having another terrific SPAC conference. Steve, Brooke, Morgan, again, another great job. I figured we'd start here with the bios and intros. My name's Brian Cavalli. I work with Edgar Agents. We are amongst the top in the SEC filings. We are the #1 IPO filer. We're the #1 SPAC IPO filer, as well as the #1 de-SPAC filer. So, again, want to thank you. We're going to keep this very, very open. And why don't we start, Seth? Why don't we start with the intros?
Sure. Good afternoon, everybody. I'd like to think that I can bring a certain perspective this afternoon. We service about 1,000 publicly traded companies, many of which are SPACs. So I own V-Stock Transfer, where we are a traditional stock transfer agency, as well as a firm called Share Media, where we focus on LinkedIn marketing for CEOs of public companies and executives.
Hi, everybody. I'm James Cotto, Managing Director of the Cotto Wealth Management Group. I lead a team of 14. That's an institutional team that services SPACs throughout their business cycle, from conception to completion. So we work all the way along from operating accounts, asset management, working our way through for alternative pipe solutions, equity comp, 10b5-1s, the gamut, block trading. So they asked me to speak because we have a unique lens because not to date myself, but since 2006, I worked with over 400 SPACs, and we're probably working with about 100 now.
Good afternoon, everybody. My name is Simon Wilcox of Alliance Advisors. I lead one of our IR and corporate advisory groups, specifically more transactional related, so a lot of IPOs, a lot of SPACs, and hope to bring a bit of an IR feel to the panel today. Thank you.
Hey, good afternoon. Thanks for hanging around in advance of the cocktail hour. I'm Crocker Colson, CEO of AUM Advisors. We are frankly agnostic between IPOs and de-SPACs. We work with SPAC sponsors, and we also work with the targets on the de-SPAC transaction and then launching their life as a public company. I've worked with over 150 companies, bringing them public, and really excited to address the audience here today.
Thank you, everyone. So I think we're going to try to keep this moving along, but I also want to make sure if anyone has any questions, no need to wait till the end. I'm going to ask questions to the panel. If you have anything, feel free to ask them throughout the presentation. So to start off, establishing a compelling IR narrative. Simon, with the SPAC IPO market coming back to life so strongly, in the past year, de-SPACs are going to face obviously a more crowded market. For attention, how do they stand out?
So I think that's a great question. It's great to see that de-SPACs are really, for want of a better word, kicking off again. I mean, look at today, look how busy we are, look how many people are here. This is fantastic. I think the thing that I see and my team sees a lot of is that SPAC teams and the private companies immediately think of themselves competing with other SPACs and other de-SPACs. But I think the thing to remember is it's not SPAC A versus SPAC B. It's everything else out there as well. You know, there's equities, ETFs, cash. So it's not so much how do we separate choice of SPAC options out there. You know, there's very few SPAC-specific investors. It's more how do we differentiate ourselves in the market and make ourselves visible. And I think one of the big part of that is this whole collective of being visible as early on as possible. It's making sure that you can maintain credibility, and I'm going to way overuse that word today, so apologies in advance. But if the SPAC and the de-SPAC entity can position themselves as early as possible to be visible, credible, to educate the market, particularly if you're something new, if there's a new technology you're bringing or something unique in the space, if you can position yourself as an educator in the market, that as you're going through your process, you're teaching, you are the go-to team to learn about this new technology, it's fantastic. Make it easy for the market to learn about you. Don't disappear into that quiet phase after the BCA, but before close. Get out there, advertise yourselves and talk about yourselves so far as appropriate, and just make it easy for the market to learn about you. Get some kind of digital presence. Add a proto IR page to your website, a BCA landing page, wherever it might be. Get your story on there, explain what your rationale is. One of the things we always think about on my team is that a compelling story is great. It will get you a meeting, it'll get you the coffee date. But it's actually the credibility of the leadership team, the credibility of the story that gets you the investor. I'll pause there.
Great. Okay. Crocker, keeping with the narrative, how does your team go about putting together an investor story, and how does that flow from the PIPE definitive agreement through the launch during that first year of trading?
Yeah, so we really like to look at quantitative analysis as well as qualitative. And so we actually looked at all 699 de-SPACs that have closed. And there's one very ugly statistic, which is 85% of them are trading below the $10 share price, only 15% trade above. So we tried to look at and a substantial percentage out of that 85% are essentially BK. So they were wiped out entirely, the equity shareholders who elected to stay in the deal. So we really tried to look at what are the success factors for the companies that go on to create value for shareholders that stay in at close. And we broke it down into a couple things. The first thing is really on the SPAC sponsors, and that is you absolutely have to choose an institutional quality deal. If you're choosing a company that's desperate, that's ill-prepared to be public, that's not at sufficient scale to be public, you're pretty much guaranteed to fail over any long period of time. You may get an initial bump out of the gate, just based on technical trading factors, but over time the market, will value it properly. The second factor is valuation, and I think particularly in the last boom cycle, we had a very competitive environment for viable companies, and sponsors tended to try to outbid each other on valuation, and combined with a general boom cycle that we had for all kind of growth-oriented equities, we ended up with a lot of valuations that didn't make any sense. And so we dug into that, and we separated the companies that raised a total of $100 million through a combination of either committed straight equity PIPE or cash retained in trust. And there was a tremendous variability in performance between those companies and the companies that raised less than $100 million or did some kind of convoluted forward purchase, equity line of credit, non-true common stock deal. And we have the statistics in the white paper that we sent out. Happy to send that to whoever wants it. But it's a real dramatic difference. So I think we were talking the last panel about the importance of going out there and actually marketing the deal to real investors and validating the valuation, because when you're dealing like a space like quantum or nuclear, you can't just go off of very clear financial comparable sets. There's going to be a lot of milestone-driven data points that are important. You need to test your thesis, test your valuation against people who are putting real money to work. And if you can do that, the single best predictor is companies that have cash remaining in trust at close. That's the single best predictor of ones that are going to be successful long term. The next major thing is public company readiness. This is where a lot of deals blow apart. They go out, they either miss their first quarter reporting, they're late, or they miss their earnings forecast, and they've completely lost credibility. And institutional investors are usually going to wait, a full year or 2 years before they take another look at that story. So being prepared to be a public company in terms of governance, in terms of having the right systems in place, forecasting, internal controls, that's the thing. And then get to the point you were asking about, which is narrative. You really have to go in with a very strong narrative arc. So we need to figure out, what is the investment thesis? How are you benchmarking against other people in the sector that you're going to be comped against? and what are the milestones that we're going to use to tell your story. Obviously, for some industries, those are going to be primarily financial milestones. For others, those are going to be major contracts. For others, it's going to be additions to backlog. That's a customized strategy for every single company. But you need to not only have a strong narrative from the BCA through to close, so ideally you get it trading up in the $12 to $14 mark, so you keep cash and trust, but then that all-important first year of being a public company, you need to be able to support that narrative so people see you have this track record of execution. You're a firm that the management team knows how to execute, not just make promises and tell wishful thinking.
Excellent. So when you're identifying and engaging the right long-term shareholders, James, we've seen the PIPE market obviously is coming back this year. How can companies, equity sponsors, provide a longer team support?
You know, I thought a lot about this question, and it's something that we present to our SPAC sponsor clients all the time. I'm so pleased to see that the PIPE market is alive. I'm so pleased to see that the back end is very busy at this time while the front end is paused. You know, it is a risk-on environment in spite of the geopolitical challenges. But you know, we always recommend to bring to the table and run a dual path, which is why you're seeking a PIPE solution. Also look for an alternative PIPE solution. For instance, we have middle market proprietary private equity funds that are able to write checks between 35 and 200 million. We're not the only ones on the street, there are many. And why I think that's important, because a PIPE, you know, you close the deal and then they become a challenge because you have to replace those shareholders as they monetize their position. Unlike a private equity investor who has a 3 to 5 year horizon. So if you can engage and present a well thought out narrative to a private equity company that's willing to engage you and either do a preferred or debt or equity or a combination of three in any way, I just think that makes a lot of sense, because from a sponsor perspective, you have a 12-month shot clock after you close. You would like to be able to maintain share price, and having private equity investors in there as an alternative PIPE solution makes a lot of sense to us.
Yeah, I mean, I have a different perspective. Anything that has a variable, reset, any terms like that, in my experience, those are essentially death sentences for the equity. So if you can do, you know, a convert that has a fixed price, great. If you can do straight common, great. Anything that's like, if you can do, you know, straight equity, that's not going to, the straight debt, that might be the right solution. But any of these forward purchase, these other exotic structures, I've almost never seen them work out.
No, okay, fair enough. So securing analyst coverage and leveraging it to the broader, to the visibility of credibility. Crocker, de-SPACs typically start without any research coverage. What challenges does this present, and how would you solve it?
Yeah, you're absolutely right. So if you do a regular way IPO, you know, and you raise $100 million, you're pretty much guaranteed to start with like 4 research analysts covering the stock. That means you have 4 institutional sales force that are behind you. You're automatically going to get invited to 4 investment conferences. You're going to start life with, you know, 20 to 30 institutional accounts who have some position, who care about your story. Maybe they're not holding it past the first week, but there's trading and there's liquidity. You're in the exact opposite position as a de-SPAC.